There's this famous Fidelity study that nobody can actually find a hard copy of, but pretty much everyone in finance has heard about it. The story goes like this. Fidelity pulled the data on their absolute best performing accounts over a decade. They wanted to know what the winners were doing differently. Were they day traders? Were they the spreadsheet nerds? Were the guys reading every single earnings report at 2 a.m.? No. The absolute best performers fell into two categories: people who had died and people who had completely forgotten their accounts even existed. Now, the study itself might be an urban legend, but the lesson absolutely isn't. The single most expensive thing the average investor does is try too hard. And on this channel, we break down the math behind the money decisions almost nobody is actually doing right. Let me introduce you to a fictional character. Let's call her Sarah. She's 32, she makes $78,000 a year. Last Tuesday at 11 p.m., she Googled how to build wealth, read 3 articles, and closed her laptop feeling worse than when she opened it. It all felt too complicated. But by the end of this video, Sarah's going to be on track to become a multi-millionaire. And she is going to do it by working less on her money, not more. Today, I'm walking you through 10 lazy money habits that quietly build massive wealth. Almost nobody is using these. Let's get into it. Let's start with a tiny little toggle switch that is hiding in plain sight. If you're like most people, you've logged into your employer's 401k portal maybe twice in the last 5 years. Both times, you looked at the confusing charts and closed the tab without changing anything. But buried about 3 menus deep in that portal is a switch that can make you an extra $700,000. It's called Auto Escalate. Here is how it works. You click it once, and it automatically bumps your retirement contribution by just 1% every January. That's it. You are done forever. Let's look at the math for our girl Sarah. She turned this on at age 32. She started by contributing just 4% of her income. 11 years later, without ever making a deliberate decision, she was contributing 15%. The toggle did all the heavy lifting. If a 32-year-old earning $70,000 contributes 4% to her 401k and never touches it again, she retires with roughly $300,000 to $400,000. The exact same person who flips the auto escalate switch retires with over $1 million. That is a massive swing for one mouse click. The problem? Most plans default to off. Because nobody told you, you're missing out. You won't even feel the 1% bump because it comes out before your paycheck hits your bank account. The default setting is broke. Change the default. While we're on the topic of accounts you're probably using wrong, let me introduce you to the most powerful retirement vehicle in the entire U.S. tax code. I'll bet you $1 your HR department never explained this correctly. If you have a health savings account, or HSA, you're probably spending the money the second it hits the account. You use it for copays, prescriptions, or a new pair of glasses. Stop doing that. Sarah has a coworker named Mike. Mike uses his HSA exactly like a debit card. But Sarah, she does something entirely different. She maxes out her HSA every year. Currently $4,150 for singles or $8,330 for families. But here is the secret. She invests the entire balance in broad index funds.
Wait, how does she pay her medical bills? Out of pocket. She pays cash and then stuffs every single medical receipt into a folder on Google Drive. Why? Because there is no statute of limitations on HSA reimbursements. You can pay for a $4,000 procedure today, save the receipt, let the $4,000 in your HSA grow tax-free for 30 years in the stock market, and then reimburse yourself in the year 2056. The IRS literally cannot stop you. It is the only triple tax-advantaged account in America. It's tax-deductible going in, it grows tax-free, and it comes out tax-free. Only 15% of HSA holders actually invest the balance. Don't be like the other 85%. This next one might sound a little insulting at first, but stick with me. The strategy is this. You buy one fund, just one, A target date retirement fund or a total market index fund. You set up automatic weekly or monthly contributions, and then you do absolutely nothing for 30 years. You don't log in, you don't check the news, you don't panic. There's an annual study called the Dalbar Quantitative Analysis of Investor Behavior. It consistently shows that average equity fund investors vastly underperform the actual market they are invested in. If the S&P 500 returns 25% in a great year, the average investor somehow only makes 16%. How? Because human beings are emotional. They panic. They sell during dips. They buy into fads when they're at their peak. They switch funds. They tinker. The market did all the work, and the humans got in the way. Over a 20-year period, missing out on just 1 or 2% a year due to tinkering is the difference between retiring with $1 million versus $1.2 million. 20% of your retirement evaporates just because you couldn't stop touching your portfolio. The lazy portfolio isn't a compromise. It is mathematically the optimal strategy for 99% of human beings because it removes the single variable that consistently destroys returns: you. If you've heard of asset allocation, congratulations, you have a solid grasp on personal finance. But there's a cousin to that idea that almost nobody talks about: asset location. Allocation is what you own: stocks, bonds, real estate. Location is which account you keep them in, and it matters a lot. Here's the golden rule. Tax-inefficient stuff, like bonds, REITs, or anything that spits out a lot of interest or dividends, goes inside your 401k or traditional IRA, where it's sheltered from taxes. Tax-efficient stuff, like broad index funds that barely pay dividends and are meant for long-term growth, goes in your Roth IRA, where it grows tax-free forever, or your regular taxable brokerage. Vanguard ran the numbers on this. Over 30 years on a $1 million portfolio, optimal asset location saved you around $74,000 in taxes that you would have otherwise willingly handed to the federal government. Most people hold a mirror image portfolio. They hold the exact same 70-30 mix of stocks and bonds in every single account. But the IRS taxes the same dollar differently depending on which drawer it's sitting in. Spend an hour moving your assets into the correct drawers, and you are done for life. The tax code does the rest. Everything we've covered so far is about lazy investing. Let's talk about lazy saving, because there's a generational scam happening in American banking right now, and most people don't even know they're the victims. You probably have an emergency fund sitting at a giant mega bank right now, earning 0.01% interest. It's been there for years. The bank is making more money off your cash than you are. Meanwhile, the U.S. government is paying upwards of 4 to 5% on short-term treasury bills, or T-bills. It's the exact same risk profile, virtually zero, but with massive yield. Here's the lazy hack. Go to treasurydirect.gov, buy a 4-week or 26-week T-bill, and simply check the little box that says Auto Reinvest. Every time the bill matures, the government automatically takes the money, rolls it into a new bill, and pays you the interest, forever, without your input. If you have $50,000 in emergency cash, the difference between your megabank's 0.01% and a T-bill's 4.5% is over $2,000 a year for zero work. Plus, T-bill interest is exempt from state income tax. Stop tipping multi-billion-dollar banks for the privilege of holding your cash. If you're still watching, you're already in the top 5% of people who actually take action. These next few habits are where the real generational money hides. This one is so new, your CPA might not even know about it yet. In late 2022, Congress passed Secure 2.0. It solved the biggest fear parents had about 529 college savings accounts. What if my kid gets a scholarship or doesn't go to college? Will I lose the money to penalties? Starting in 2024, you can now roll up to $35,000 of leftover 529 money directly into your child's Roth IRA. No penalty, no taxes. Why is this insane? Because Roth IRAs have income limits. If your kid grows up to be a highly paid software engineer making $200K a year, they normally can't contribute to a Roth, but this rollover has no income limit. Imagine dropping $35,000 into a 22-year-old's Roth IRA. If they never contribute another dime and it grows at 7% until they are 65, that account becomes over $600,000, completely tax-free forever. You filled out one form and you just bought your kid $500,000 of retirement. Now we're getting into the stuff that used to be strictly reserved for the ultra-rich. It's called direct indexing. Normally, when you buy an S&P 500 ETF, you own a neat little basket of 500 companies. With direct indexing, the brokerage platform buys all 500 individual stocks for you. You have the exact same market exposure, but now there's a piece of software, a robot, watching every single stock.
Whenever one specific stock dips below what you paid for it, the robot immediately sells it, buys a nearly identical stock to keep your portfolio balanced, and banks the loss. This is called tax loss harvesting. You can use those banked losses to offset capital gains on a house sale, a business sale, or up to $3,000 of your regular income every single year. You do absolutely nothing. The robot does everything. 5 years ago, you needed $1 million to access this. Today, brokerages like Schwab, Fidelity, and Wealthfront let you do it with just a few $1,000s. Vanguard estimates this adds 1 to 2 percentage points of after-tax return per year. Over a few decades, that could mean an extra $350,000 in wealth. If you work at a mid to large company, there's a roughly 50% chance you have access to this next strategy, and a near 100% chance nobody told you about it. It's called the Mega Backdoor Roth. The IRS limits your standard 401k contributions to around $23,000 a year. Most people stop there. But the actual legal ceiling on a 401k is almost $70,000. How do you bridge the gap? Through a bucket called after-tax contributions. If your 401k plan allows it, you can funnel extra money into this after-tax bucket and then have it automatically convert into a Roth IRA every single paycheck, on autopilot. That is tens of thousands of dollars of extra Roth contributions every single year. You are multiplying your tax-free wealth space by 5 or 6 times. Max this out for 20 years, and you are looking at an extra $1.8 million of completely tax-free retirement money. Call your HR rep on Monday and ask, does our plan allow after-tax contributions and in-service Roth conversions? If they say yes, you just struck gold. Mainstream financial advice assumes you are going to work a full-time job, making the exact same or higher income from age 22 to 65. But real life doesn't look like that. People get laid off, people take sabbaticals, people stay home to raise kids, people burn out. Every single one of those income drops is a massive tax-saving opportunity thanks to the Roth conversion ladder. In any low-income year, say a year you took 6 months off to travel and made very little money, you convert a chunk of your traditional 401k or IRA into a Roth IRA. Because your income for that year is super low, you pay taxes on that conversion at a tiny tax bracket, maybe 10% or even 0%. After a 5-year waiting period, that money becomes completely withdrawable, tax-free and penalty-free at any age. You are legally manipulating the tax brackets to move your money from taxable to tax-free for pennies on the dollar.
I promised you lazy, and this last one is the easiest item on the entire list. You can literally do this tonight in your pajamas in 30 minutes, and it will save your family tens of thousands of dollars. Right now, your bank accounts and brokerages probably list a beneficiary you set up 10 years ago, or maybe nobody at all. When you die, if your assets aren't structured correctly, your family doesn't get the money right away.
The courts do. It's called probate. It takes over a year on average, and attorneys will skim 3% to 8% off your entire estate in legal fees. On $1 million estate, that's $50,000 gone. Here is the fix. Every bank account, brokerage, and in many states, even your house can have a transfer on death or payable on death designation. Log in, add your loved one's names, log out. When you pass away, those accounts skip the nightmare of probate entirely. The money transfers instantly, totally private, zero court fees, zero attorneys. It is the highest impact 30 minutes of your financial life. Let's zoom out for a second. If you walk away remembering only one thing from this video, let it be this. The wealthiest Americans are not the smartest. They aren't reading the most financial reports. They aren't the most disciplined. They are the most automated. Every single strategy we cover today shares one trait. Once it is set up, it runs without you. It requires no willpower, no spreadsheets, no checking stock tickers on a Sunday night, no anxiety. We've been sold this lie that building wealth requires intense effort, sophistication, and constant attention. The data says the exact opposite. Wealth requires you to set the system up and then physically stop touching it. Remember Sarah? She didn't outsmart anyone. She didn't buy my expensive course. She just turned on a few toggles in her 30s and went back to living her actual life. That is the whole game. So here's your homework. Pick one, just one. Don't try to do all 10 this weekend. That defeats the point of being lazy. Pick the easiest one, probably your TOD designations or auto-escalating your 401k. Spend 30 minutes on it tonight, then close the tab. Go watch a movie. Go for a walk. Let the money figure itself out. The default is set to broke. Change the default. If this video helped you, hit the like button so the algorithm knows it's valuable, and subscribe for more math-backed financial strategies. I'll see you in the next one.